Good afternoon, everyone. I hope everyone can hear me. I would like to take this opportunity to welcome everyone to CRDB's third quarter 2024 results call. I would like to welcome CRDB to start their presentation, and I would like to acknowledge the management, the whole management under the CEO, Abdulmajid Nsekela, and Fredrick Nshekanabo, and the rest of the management team. Please welcome.
Thank you so much, Prof. Thank you for having us. Maybe just by introduction, today we have our MD with us, Mr. Abdulmajid Nsekela. We also have our head of strategy, Ms. Caroline Yabesi, joining us. We have colleagues from the investor relations team, from Treasury, Credit, and of course myself, Adam Masha, in investor relations. So for the day, we're going to start with our operating environment, and then the strategy execution, and then the CFO will take us through the financials, and then the way forward, and then we'll open it up to Q&A. So without further ado, Abdulmajid, Karim-san.
Once again, good afternoon. Thank you, Prof, for arranging this call, and also thank you for the participants also joining the call. We'd like to go straight to the presentations, and I'll start covering the operating environment, basically covering the area where CRDB is currently operating. For Tanzania, I would say that the economy is progressing well. We haven't seen much changes, especially the inflation side. It's remained stable at around 3.1%. We have also seen the money supply ranging to the 11.3, which is, it has been a squeezed market in terms of liquidity. Nevertheless, I think I'll touch base on the CRDB if you look at the money supply, how we've been performing basically. In terms of private sector, there is slightly growth, relatively moving to almost 1%, 17.5% compared to the last month. We'll see about the 16.7%. They still in the lower side compared with the last year progress. I think what we have seen is more of activation of most of the sectors, especially the key sectors which drive the economy. The like of manufacturing, we have seen significant investment coming in. We have seen significant private sector where we have some factories that are being established. Transportation is also growing steadily well, but also we have seen a great investment of the mining sector, as well as tourism, as we speak. I think the kind of sectors which is really over. If you look on the current in terms of foreign exchange, I would say there is slightly improvement compared with the last 3 or 4 months ago, and we have seen current rate ranging around 2,700 coming from 2,600. However, we have also seen the influence of forex and the current challenges they are made on the tissue side. I think there has been some slight changes for key policies. We have seen, for example, central bank issuing some of the advisory notes, where asking the finance sector to think about gender equality, and it's not a cycle of risk, but rather than advisory for the board and mind to think how best to provide management leadership to consider the issue of gender equality. And I think the sustainability is becoming a key agenda. Now, I'm sure that most of the banks are legally compliant with central bank compliance, for CRDB being in the leading role of that space. And we haven't been achievement we have achieved so far. In terms of policy adjustment, we still continue to see kind of policy adjustment, especially on the private sector perspective. But we have also seen some of the regulatory Tanzanian authorities taking the deliberate measures to invite banks to discuss on how best we can continue to support business community to be created of conducive environment for tax collections. And this has also greatly improved the confidence level. If I look on the road side, there has not been much changes on the economy. We still believe that what is being approved for implementations is still in progress. But we are happy to see that our road operations is becoming more profitable. As we speak, our road operations, we are leaving the sector as we speak today, but we still see a lot of changes in terms of looking for the special group, especially for micro SME as well as women empowerment. Although the government has also worked closely with the banks and central bank to remove some of the barrier which was limiting foreign accounts to be operated in the banks. And that is also necessary to get key, I would say, NGO, international organizations to work with us in Burundi. So we are happy with the performance of Burundi-based credit. If I touch on DRC Congo, we are relatively performing well. It's almost a year since we started operations. Basically, we had a couple of limitations, which has been already also addressed. The issue of respondents bank, the issue of operations, but also the navigations within the operation of the market. What we are happy with, if you look at the performance, we are yet to break even. At least the projected loss has significantly declined, and we hope by next year we should be able to break it even. And that is a great expectation, a great moment. But also we have been able to integrate our operations in terms of tax payments, supporting private sector for both Tanzania and DRC Congo, where they should be able to pay seamlessly to Tanzania, and in that way just create a room for more deposit generations, which was the battle of the limitations. Another business line which we are happy with the progress, I think, is on insurance as our subsidiary. Remember, the reason why we integrate insurance with our operations is to provide at least the degree of the customer needs. And basically maximize the current customer base we have within the group, provide insurance service which was not there. And we are happy with the current performance of insurance. We expect the insurance company to break even in year one, and before year end, we should be able to book positive results. But at the same time, the current business within the group is benefiting from our insurance company, and we see a greater potential coming ahead. And this is how we expect to continue managing our risk, while also including our partnership within the insurance space. That was more or less on the environmental perspective. I've not covered 100%, but I believe all investors in the call, they have seen those kinds of trends happening. If I was to look on what we have achieved, why we are where we are, and what has been the contributing factor, there is great achievement as a bank of what we've achieved today. And this is, I would say, the second year of our strategy. We are both moving the same year, but we are having the achievement. And remember, the key pillars which is carrying our strategy, there are three. One is about to invent the business which we have, also grow the business within the current space, but also create the future for sustainability. So if you look on the reinventing the business, one was about to extend the services we currently operate by readjustment, digitizing, automating, and efficiency. But more importantly, it's also to strengthen our channel optimizations, where we have been able to connect in terms of payment seamlessly, but also deposit acquisitions through our alternative channel, supported by our branches. And that has enabled us to create more services to our customers, and also create kind of leverage from the partnership of other infrastructure which have already been created, and enabling us to ensure that our customers are able to onboard seamlessly and be able to be supported in the operations. The other key, key investment we have done is to enable our current infrastructure in terms of iTrust banking, more than $30 to be able to acquire customers. And as we speak, we are in the range of acquiring 150 to 200,000 customers in a month. And this has increased our customer base. It has also increased our team ratio on the digital channel. The other key fundamental activity we have done is about strengthening our MSME offerings, where we have revamped the MSME, categorizing in three category. One is about looking at micro specifically, where the digitalizations has been completed. There's now seamless processes. We have also categorized the mid SME and mid corporate on the space of SME. Our focus has been pure on the SME, both in agriculture, tourist, manufacturing, and other services. But nevertheless, on the same space, we have been able to automate the consumer offerings on the consumer side. We no longer invite customers to branches. Currently, the customer should be able to apply the facilities, purchase themselves, until disbursement with their mobile phones. So we have integrated our system together with the government on the payroll system. And that has created a room for efficiency where we have been able to move our staff to the more front services from the back office side. And remember, all of our strategy was about having 70-30, meaning that 70% of our workforce should be on front side and 30% should be back. By that process of automations, it has basically addressed significant operation efficiency to improve our operations. I think the other issue is about our response time. Apart from the normal call center stuff, currently we have the chatbots, which is answering the majority of the more frequent asked questions. And that means leading our staff on key activities, and that has improved our services. On the side of the I'll say growing our business, remember, I think payment mechanism scheme. I think one of the things we have done is to improve our payment systems, digitizing, but also connecting majority of our suppliers, vendors on the merchant services, to ensure that we ring-fence the deposit within the chain without losing it. But we have also introduced another services of the virtual card, together with Union Bank and secured payments or online payment. And now you don't need to be sending customer to make payment. Basically, I think for those who have historic about COVID payment time, we're able to enable payments, especially for business staff, where you're not sending customer, so you can still make payment. And that's how we are defending the current business we have as well. But the other initiative we have done, I think we are looking where the deposits come from. I think currently we have integrated all the religious, I would say, organs, especially for the, I don't know how to call it, the best word language, Sadak and the other stuff, where currently the majority of believers, and when you will see a great, if you have seen our number in terms of deposits, that's how we have been able to raise those, I'll say, affordable deposits through the payment mechanism and enabling the payment differently. I think another issue which is also great in terms of initiative is about financial inclusion agenda being supported by our foundations, saving foundations, where we are focusing purely on the informal and informal, on the women, which we call special groups. We have run country-wide initiatives together with our UNDP, what we call UNDP for War program on innovations. And this has greatly supported us to untap those untapped customers or unprivileged customers on the rural area. And we have been able to mobilize significant deposits from that end. When we speak about the future, I think for CRDB remains at one of the things about partnership, and it's within our strategy. And we have to be strong in terms of talk about funding, be able to take advantage of the bigger projects. But we can't do it ourselves without creating partnership with our key stakeholders. We have been able to close a bigger deal with big mining companies, the graphite companies. We have sent funding and both de-risking and then expanding with key stakeholder, PFC, IFC, FP, FMO, and that's greatly given us a headwind in terms of liquidity, but also modifying our offerings, offer more affordable credits specifically to our customers. Within that arrangement, we have also incorporated the capacity building of customers, but as well as capacity building within. And through the partnership we have created, we have been able to do a holistic review of our current processing, test the key tools and processes which enable us to manage our portfolio better, be able to deal with the keys, if you look at the number in terms of quality management. And the key fundamental advantage is also that within the partnership, there is also room for de-risking. And remember, the growth we are moving in, it has to be sustainable, it has to be aligned with the capital growth, it has to be aligned with our liquidity. So with the partnership we have created together with our key partner, global partnership, it has enabled us to manage our business growth while managing our capital efficiently and create room for further growth. And there's been a great investment on our staff, and if there's a need to keep leadership in terms of strategic plans, and you can see that we have been able to address a lot of different sectors from within, and we still have a great talent where we have partnered with key universities to strengthen skills within the organizations. And that goes all the way to all the functions, so that we achieve efficient and robust future risk kind of management. Nevertheless, there is ongoing in terms of interpretations. And as we speak, we have implemented the regulations. We are currently putting operation in order to ensure that we remain resilient, but also observe the regulations, which is currently being introduced. Nevertheless, I think the key milestone, I would say that the engagement we have done, which is critical, I think, in this slide, it has also enabled CRDB to position itself to attract more global institutions whom we are currently releasing as partners. So we believe that those initiatives is what makes us be able where we are today in terms of performance. Just to wrap up the success factor, I think we have also been recognized by many institutions, getting a significant number of awards, which I believe it puts the brand better, puts us in a hub of success, and we should be able to achieve expected results as we end up the year, also looking ahead for the 2025. Without taking much of time, I would like now to invite our CFO to quickly run through all the numbers, then we can have the discussions on the next slide.
Thank you, MD, and once again, thank you all joining. We are able to record a strong performance as we close Q3 of the year, and on the back of the achievement highlighted by MD, you note our profit after tax grew by 46%, closing at 409 billion, which is again ahead of the industry growth, which is growing at 35%. The total asset closed at 16.1 trillion, which is a 26% growth on year on year. Again, ahead of the market share by 27%. We closed with a loan book of 10.1 trillion, which is 24% year-on-year growth, again commanding a market share of 29%. The customer deposit was growing at 18%, well above the highlighted M3 growth on the micros, but again, commanding 25% of the market share. Our NPL closed at 2.6, well below the industry, which is at 5.6. Our return on equity closed at 28.1, again, ahead of the industry, which is at 13.8. Our cost-to-income ratio closed at 45.6, again, below the industry cost-to-income ratio, which is at 63.1. Just to take you through the details in terms of the P&L, as highlighted, we closed with a strong profit after tax, growing at 46% on year-on-year, mainly driven by the growth on the top line. The interest income grew by 30% on the back of the portfolio growth. But again, as we updated in the previous quarter, we continued to review our loan portfolio price in line with the market interest rate trends, but also realigning our portfolio mix. Our non-funded income grew by 23%, as I will highlight in the next slide, mainly driven by the alternative channel on the back of the volumes and the usage increase, mainly driven by SIM banking, card business, and agents banking. We are happy to report on the progress we have made so far on our NIM. We closed with the NIM of 8.9, mainly on the back of what I've highlighted as our strategic initiative to realign our portfolio in the high yield, but also aligning our loan portfolio pricing in line with the market trend. Our cost of funding, despite of the liquidity squeeze in the market and the increased interest rates, particularly on the local currency, remained at 3%, mainly supported by our ability to mobilize cheap deposit, but also mobilizing long-term funding, alternative funding through the borrowing. The fee commission continue to contribute about 80% of our non-funded income, mainly driven by the alternative channels, SIM banking leading by 52%, 29% coming from agents banking. As highlighted, our digital transformation initiative is working, and you could see more volumes and the usage on the digital channel is picking up. 97% of our total volumes are happening on the digital channel. And these transactions actually are happening, most of these transactions are happening after our branches have closed. Close to 40% of our transactions take place on our digital channel after we have closed the branches. In terms of the efficiency, as I've highlighted, we closed with our cost-to-income ratio at 45.6%. That is coming from 51% in a similar quarter in last year, mainly driven by our strategic initiative to leverage on our digital transformation, the automation highlighted by MD, whereby we have been engaging in automating our process. We updated on our strategic initiative to automate the back office process, take more of our transactions on our digital touch points. And as I've highlighted, 97% of our transactions are taking place on our digital touch points. And that is actually giving us a mileage in terms of the cost saving, but also driving the volume on constitutes on the more efficient service delivery channels. The operating cost increased by 16%, mainly driven by the growth in the business. As we highlighted in the last quarter, we opened up 2 new subsidiaries in the Tanzania market, which is the insurance subsidiary and the foundation. And we also opened 1 cross-border subsidiary, which is Congo, which we are now reporting more or less in a full year operation. And that has a significant contribution on our operating cost growth, but also the business growth that we have recorded during the year are driving the 16% growth in the operating cost. We closed with a strong balance sheet, with the total asset growing at 26%, closing at 16.1 trillion. This is a leading balance sheet, mainly driven by the growth on the loan book, which is growing at 24%, closing at 10.1 trillion. The major area of growth, again, as we updated, we continue to focus growing our retail segment, particularly the SME and the MSCs and in agriculture. That's the main segment, and as you note in the next slide, that continues to be our focus, and that's where our biggest percentage of the portfolio mix is standing. Our deposit closed at 10.1 trillion, growing at 18%. Mainly, again, the major contribution of the growth in deposit is coming from the retail, as you will see in the next slide, where we discuss about our deposit split between retail and the corporate. Our borrowing grew by 56%, in line with what we have highlighted in the micro. You could see the mismatch between the M3, which is growing at 11.5, but also you see the growth in terms of the credit to private sector, which is growing at 17%. With the liquidity squeeze in the market and the mismatch in terms of the funding in the market, we started to fund our balance sheet and support the business growth through our borrowing, which grew by 56%. But mainly, these are long-term funding to support the long-term balance sheet growth. And in the previous discussion, as we highlighted, the balance sheet is actually inheriting the maturity mismatch, and that's an industry issue whereby we have more of the long-term funding requirement supported by short-term funding, and thus most of the banks, you'd see the swelling of the borrowing to try to match the mismatch in terms of the funding and the maturity gaps. As I highlighted, 53% of our total loan book is on retail, and 47% of our loan book is on corporate, well distributed across the key economic sectors. Personal loan 36%, agriculture 18%, trade 13%, manufacturing 8%, building 4%. So the main, as highlighted, the main focus in terms of the portfolio distribution, we continue to see more of the growth on the SME, MSCs, and the agri compared to corporate. Though when you look at in some terms of the absolute value, you realize corporate, the cost is a bigger ticket, but when you look at the growth, you realize these segments which are strategic focus are the ones that are recording the highest growth. In terms of the loan portfolio quality, we closed with our NPL at 2.6, mainly corporate contributing 55% of our NPL and 45% of our NPL coming from retail. Overall, our coverage ratio improved from 35% we reported in the previous quarter to 43%, mainly coming from the curing of the two corporate customers among the three we had reported in the previous quarter. We continue to monitor and closely work with the outstanding, the one corporate customer outstanding on the MPL. And we are confident by the end of the year, we should see him moving to the performing status. In terms of liquidity, we closed with a strong liquidity position despite of the challenge in the market. Liquidity 27.6%. Liquidity ratio well above the regulatory requirement. 66% of our funding are coming from deposits, and this is, as you see, well, coming from the cheaper deposit. Our CASA deposit is closed at 82%, and that's the main actually contributor on what I've highlighted. When you look at, despite of our the liquidity challenge in the market and the increasing funding cost, you realize our total funding cost remained at 3%, and that's mainly coming from our funding mix. 21% is coming from borrowing, but again, these borrowing are relatively cheaper because they are long-term compared to the shorter-term funding in the markets. In terms of the mix, as I have highlighted, the deposit mix, mainly the total deposit is mainly contributed by the retail deposit, which is contributing 63% of the total deposit, 37% corporate deposit, and as highlighted, 82% of our total deposit are CASA, and they're mainly explaining the stability, the stable and the sticky deposit supporting the business growth. In terms of the capital adequacy ratio, we continue to maintain a strong capital adequacy, well above the regulatory capital requirement. We closed the quarter at 14.2% core capital and the 15.3% total capital, well above the 12.5 core capital and the 14.5 total capital regulatory capital requirement. We continue to monitor our capital position, our strategic initiative to make sure that we are able to de-risk our risk-weighted asset growth, but also leverage on the partnership and the syndication to ensure we are able to minimize the risk weight that we take on our balance sheet and relieve the capital to support the business growth. We continue with the implementation, the parallel implementation of the Basel II, Basel III. We so far, with the trust that we have been able to run, we are confident that we should be able to comply with the capital requirement with the full Basel II, Basel III capital requirement come July 2025. In terms of our subsidiary, we, as highlighted by MD in the first slide, our three subsidiaries continue to post a positive contribution to the bank. Burundi closing with a profit after tax of 29 billion. Our Congo subsidiary closed with a loss of 9.1 billion, well in line with the budgeted number. We are happy to report the progress in terms of the performance on our Congo subsidiary, and we're on track to break even within the planned time. Our insurance subsidiary closed with the 501 million loss. We are happy to update that we should see our insurance subsidiary closing, breaking even as we close the year. And in total, the 3 subsidiaries continue to contribute a positive contribution of 6% to the group. As highlighted by MD in the first slide, we continued with the financial inclusion initiative through our CRDB Foundation, capacity building to the women and the youth. We're able to reach our a total 183,000 compared to 77,000 number of beneficiaries as we close the quarter. And we're able to extend the seed capital of total 105.2 billion compared to 496 we had recorded in the previous quarter. We continue to engage, and we see this segment through our flagship product in Beju. We continue to see this product as one of our key products to the market towards the financial inclusion and reaching out the segment which otherwise has not been able to benefit from the financial services. In terms of the stock performance, we are happy to report on the great progress made in terms of the market capitalization. We closed with a 1.67 trillion market capitalization with a growth of 45.5% in terms of the market capitalization from the previous similar quarter last year, closing with a share price of 640 shillings per share. Important to note, CRDB stock has been the highly traded stock in the market, and we appreciate the investors' reaction and the participation in the capital market in terms of aligning the bank performance with the market price. 45.5% growth on year to year in terms of the market price is not a small growth. Positive, we should see further growth in terms of the price, but important to note in terms of the share structure is the growth of the market share in terms of the local individual ownership, which grew to 33% from 30%, where the foreign investors has decreased from 22% from the previous similar quarter to 20%. I'll just stop here and maybe allow for the questions before we go to the outlook.
Thank you very much. Thank you. Prof, over to you.
Yeah, thank you very much. I think Abdulmajid, Fred, for presenting the financial results. Let me take first note that it's really fantastic to see the performance of CRDB in terms of profitability, in terms of its growth in assets, deposits, and loans. Profit after tax up 46%, the assets up 20%. Deposits. I think we have some interference. Okay, so I think with net loans up 24%, deposits up 18%, and NPLs at 2.6%, with the cost of funding at 3%, the net interest margin at 8.9%, and the cost to income ratio of 45.6%. I think these are fantastic performances. I think I really congratulate the management and CRDB on this particularly really good performance. I think what I will suggest, if it's possible, is maybe we go through the way forward from the management before we open up for questions for investors, because the way forward is the most critical for investors generally.
Thank you, Prof. Again, on the way forward, as you note from the slide, not different from what we reported in from the previous quarter. You note we closed with our loan book at growth at 24%. We are confident that we should see the loan growth at 15, in the range of 15 to 18%. As you note, and we updated it from the previous quarter, we continue to see the settling of the loan growth from the post-COVID catch-up growth, but also with a mixed impact from the strategic initiative from the government to activate the business community. We have, as highlighted by MD, you note the investment growth and the major areas where we see the growth. But nevertheless, we see more of the catch-up growth just easing. And that's why we are confident we should be seeing the growth settling in the range of 15 to 18%. Deposit, despite of the liquidity challenge in the market, particularly in the local currency, but we are confident we should see our deposit growth in a range of 16 to 25. The non-funded income contribution to the total income, we are at 39. We are confident we should be seeing our deposit, our non-funded income contribution to total income in the range of 35 to 40%. Our cost-to-income ratio, we are confident we should see it as we close the year at the range of 43 to 47%, and that's coming from 45.6%. Our return on equity from 28.1, just closing in the range of 25 to 30%. Our return on average asset closing in the range of 4.5 to 6.5, and that's coming from the 5.3. We have closed the third quarter. Our NPL again closing in the range of 2.5 to 3.5, coming from the 2.6 that we closed in during the quarter. Prof, thank you. I'll just stop here and then hand over back to you for the questions.
Thank you very much.
It was to add just 3 comments on Friday's summary. On the way forward, and you know that this week we'll be launching our infrastructure fund. So we do expect to make substantial deposits, the same initiatives. That will just give us a strong edge toward the year-end closure. The second issue that currently there is ongoing sales of cash marks, where CRDB is the majority lenders. You expect to see much inflows of the forex coming from the same seasons, but also repaying some of the facilities. And the last part is more of what we have seen from the coverage ratio. I think the biggest comment we have had in the previous discussions was about why our coverage ratio is down compared with the trend is not positive trend. I think we have managed to address 2 customers. We remain with one which is purely on the agri side, but I'm happy that in the last 2 weeks we have also addressed and we expect the same to be in a better performance where the issue which was holding it to be addressed, and that will also give us greater improvement of the coverage ratio as well as in terms of our portfolio quality. That's my additional comment on our CFO summary.
Thank you very much. I think we can go straight to the questions. I'll start off with Chris Mtui had a question on non-funded income. He was wondering whether these non-funded incomes include the off-balance sheet facilities, the guarantees, and how they have been growing. He can see the fees for agency banking and SIM, but he was wondering on the off-balance sheet fees.
Prof, should we take that one or we take the other?
I think let me give you a few so we can take them together. I think Nathan Venancy had a question on can the management share an expected projected increase of dividend per share? So I know your dividend policy is public information, is 35%. So is there any change on that? And what is the expectation for dividend per share? I think with those two questions, we can start with those two questions, please.
Maybe now we take the second question, and I think Prof, you have answered the question already. Basically, the policy will remain the same. There has been no any discussion about the post investment until the end numbers. So we still project the policy to be observed toward the performance of the bank, and that will be determined with the future numbers after the audit. I think the trend is very clear. There will be increment of the historical payment. Thank you. And maybe CFO can cover this, the first
one. Thank you, MD, and thank you, Prof. On Chris' question on the non-funded income from the off-balance sheet, as you note, our off-balance sheet will continue to grow, but key to note is the growth in terms of the off-balance sheet. Is one of the leading line, but it's not among the top line as we have highlighted. The key line that are driving our non-funded income, the digital channel income, and the fees and the commission from off-balance sheet are part of the non-funded income, as highlighted from the slide, that are recorded on the other commission and the fees, but they don't form the significant part when we compare to the other income, though the growth is in line with what you see in terms of the growth in the off-balance sheet. But key to note, these are mainly corporate customers, and depending on the risk that you take on the off-balance sheet. And our strategic focus is to make sure that we are able to de-risk whatever we grow on our off-balance sheet. We don't take much risk, so in terms of the fees that we charge are not that much high, but relatively are in line with the growth that you are seeing, but do not form the significant part. Important to note is that the fee that we collect are also matched against the maturity of the facility. So there is the amount that is also deferred depending on the maturity of the facility. So we recognize and record the income as we continue as the facility continue to mature. So the growth that is recorded on the non-funded income is not that significant compared to the lines that we have highlighted, but it is in line with the growth that you see in the off-balance sheet.
Thank you very much, Fred. I would like to welcome Muammar. Muammar?
Hi, Prof. Can you hear me?
Yes.
Hi. So congratulations to the CRDB team on the fantastic results. I just had a few questions. So my first question is on the growth in your SIM banking revenue. It's phenomenal growth, and I just maybe wanted management to unpack that a little bit. Have you changed the fees, for the services you provide within the SIM banking, or are you just seeing phenomenal growth in your transaction frequency? So that's my first question. Second question is on your liquidity in relation to your total capital adequacy ratio. So your liquidity or your loan to deposit ratio is close to 100%, and your total CAR, yes, it's at 15.3%, but it's pretty close to where the minimum capital requirement is of 14.5. Is management concerned about that thin buffer? And if so, what kind of action plans do you have in place to fix that? And then in relation to that capital adequacy ratio, You mentioned a transition to Basel III. Is there any systemically important risk charge that applies to CRDB as well as maybe other systemically important banks in the banking system? And what would that be vis-a-vis what it is now? And then my last question is on your NPL. So it is low, but there's this single name that's been giving you trouble. You've mentioned it in the last couple of calls. I just wanted to ask, does the 12-month right of policy in Tanzania still apply? And if so, how far or how close is this particular exposure from being totally written off? Thanks. That's it for me.
Thank you very much. I'll answer some of the questions, and of course, CFO and other colleagues may chip in. I'll start with the question about what we have done in terms of SIM banking and why we see the revenue has significantly increased. We have not changed our pricing mechanism. Basically, we have actually reduced our prices and even offering free services. But what we need to know that we recently made migrations from the old system to new systems, where we have now enabled most of our customers to be able to transact more with additional services. And the second issue that the currency performance has been actively performing well and available with it. And also the number of customers within the SIM banking in terms of activity ratio has increased. If you look on the customer base, we have been saving. So we've been able to clean story for that and actually improving the performance of the system, but also improving the customer base. Currently, the customer reach, before it was about an average of 3,050 to 400 customers operating on monthly basis. Now we're talking about 600,000 customers transacting in a month. We still have a bigger room, given the fact that we have almost 2 million customers qualified for SIM banking, and we are still migrating others. So we will still see exponential growth of revenue for SIM banking, while services in terms of speeds have been reduced. Balance inquiry, some of the transfer within the systems, we have removed all the charges, but we're still making a significant revenue. And that's the great reasons why you see our SIM banking becoming more active and vibrant. In terms of revenue, I think the other question you mentioned was about LDR compared with the capital issue. And I think on my explanations, one of the things I highlighted was we are really obvious the same management concern, because we need to improve our buffer of capital base, regulatory, we have regulatory, we have internal, and that means we should be able to operate within internal limits. And you have been observing what internal limits. Also trying to improve on the capital base. Measures which we are taking place. One, I think I mentioned about the collaborative effort we have created within ourselves with the partners. One of the underlying factors about de-risking, and we have been able to risk the majority of the services. Secondly, on the off-balance sheet specific kind of services, we are currently managing off-balance sheet together with partners, where CRDB is becoming more transaction advisor, but also transaction management, and generating quite significant revenue. And the third item is about the change of the focus on terms of retail vis-a-vis corporate, and that is also comes as an advantage to improve our capital base. And the greater focus the coming years is on SME, MSC, and based on the retail space, which we believe that we should be able to do it much better. And I think the other things which we also need to be mindful that if you do assessment in the market, CRDB is I would say balanced in terms of all the balance sheets in terms of the assets. We have more or less equal balance sheet between the corporate retails, unlike other banks where you see the bank small retails, and there is proper tend to change. I think the comment you made was about whether NPL currently looks very low, and the policy of annual rate of is still valid. The answer is yes, it's still valid. However, from the current operating model we have, we don't see much challenge on the new facilities and facility have created for a couple of 2 years back. Basically, the quality of the portfolio has significantly improved because of the internal processes and the end systems we have put in place. Based on the recovery side, our supervision functions, but also the quality assurance aligned team within the general value chain of the operations. And we have a first line of quality assurance before reaching that state, which always identify all the gaps and be able to fix within. The biggest one was, do we have any facilities which you anticipate to make challenges? As we speak, so far, I don't see that. Nevertheless, it will depend the future. But so far, we are comfortable with the current customer base, customer quality. And I've also touched the base to respect about one of the fundamental customers of the agri space, which is with a big exposure, where we are much comfortable what we see, what is being implemented. And that will address one of the areas of challenge you see, not from the government, but also the ECL as well as the provision. And you will continue to want the same as we move forward. Now, maybe let me ask CFO if there is an additional comment on the question if I'm not covered.
Thank you, MD. Just to add on few on the digital channel volume increase. As we updated in the previous quarter, we have been on the mission critical core system implementation. We are happy to report we have been able to make great progress. We completed the migration of the core system to the ESP, mostly the digital channel, and we have seen a significant improvement in terms of the system performance, but also attracting and supporting the volumes that are coming from the digital touch points. So that's an addition, and we are confident that as we complete the core system implementation, which by end of Q1 next year, we should see a complete mission critical systems completed. We should see more volumes and the more contribution of the non-funded income from the digital touch points. The other question was on the Basel II, Basel III. We don't have systemic important banks charge coming from Basel II, Basel III. And the regulation gives the local regulator to just define in terms of the charge in terms of the systemic important banks. I think, yeah, the 4 consecutive quarter charge off on the non-performing loans is still applying, and we don't see it being uplifted by the central bank.
Thank you, Fred. Thank you, Fred. Prof?
I think what Muammar's question was, in addition to that 4 quarter, is how close is this corporate borrower to that meeting that and being in the charge off?
Okay, I think you have highlighted that we don't have a significant exposure on the corporate, which is anticipated in quarter 4, quarter 4 closure. Basically, what I highlighted that under corporate, we will see an improved area on the agri side, because we expect the customer which was holding on that particular category to be moving to the more of operational category, which is better category. So you will see an improved segment of the corporate side, and we don't see much. We don't anticipate as of now a challenge of the remaining period of the quarter. Thank you.
Thank you very much. I think there is a question from Hanif Jaffer. He's asking the percentage usage of SIM banking to your total accounts. I think maybe a flavor on how active and how many of the CRDB customers actually use SIM banking to just see the growth coming up.
Okay, I think when I was talking about the SIM banking, one of the steps we did was, you remember, we have migrated from the old system to the new system after completions of our ASP systems. And that being the case, we have been able to clean up our data by removing all the dormant accounts which was in the systems. We have remained with the active migrations, and we have migrated, and I said about that initially with about 350,000 customers. We are now to the range of 650. But if you look at the customer base qualifying for SIM banking, they are close to 2 million customers. So there is a process of moving these customers to the SIM banking while also recruiting the new one. And the other comment I made was about ongoing program about financial solutions. Remember now, SIM banking is a channel, it is no longer a product, it's a platform. And that means whoever customer being acquired in a specific category of customers, it goes hand in hand with SIM banking from financial inclusion training perspective, usage perspective, and what the service in. So every month there is incremental numbers, and that means equally the income reward has continued to increase. Thank you.
Thank you very much. I think Darren Smith had a question on is asking, can you comment further on the low NPL coverage ratio?
Okay, I think these have been the frequent asked questions, and we have been responding. And today, I think you have seen an increment, the coverage ratio, basically from where we reported in the previous quarter. The last time we had a meeting, I think we spoke about the customers. Those two customers being addressed, that would give us the room of where we see the increment. The remaining customers which have just touched base, these are the agri customers, which has been more or less collected. It should be okay by end of the quarter. You should see our coverage ratio moving from where it is to the range of 60 to 65%. And that's how the potential improvement will be seen toward the end. And the other issue is about the improvement we have done in terms of portfolio quality, and which we greatly expect to see a much improved coverage ratio as we need to close the year. So I think that's the reasons, and maybe CFO, if you have any additional comments.
Thank you, MD. Just to add on this one, as we have been updating, you note we still have a significant portfolio of our NPL, which is highly collateralized, and that actually explains what actually you see in terms of the coverage ratio. Because in any case, if you put them through the ECL model, you definitely have the mitigation to cover. Unlike if you have the bigger portfolio, which is seated on consumer lending, and then you are passing over stage 1 NPL, which for sure will have no mitigation, the coverage ratio is likely to come close to 100 or above 100%. That explains, and then it is an inherent structural point in terms of, unless you go and then ignore the collaterals in the ECL model, you realize you have the coverage to the levels that you are saying. But we continue to monitor this portfolio and make sure we are able to have adequate coverage in terms of the NPL.
Thank you very much. I think the next question I was just going to ask is, I think a few questions, I'm going to summarize them together. One is by Chris Mtui asking about, are the banks migrating to Basel III, or can they use other Basel levels and stay there? And then Nathan Venancy was asking about the revenue by each service, each segment of the bank, by department, how that distributed between probably corporate, retail. And I think Bhavit was asking, I know that the deposit 20% is about FX deposits and local currency means 80%. Bhavit was just asking on deposit mobilization, how the bank is working on deposit mobilization. And finally, I think Abbas Walji was asking about Burundi, its performance, and whether the bank has other plans to open more subsidiaries.
Maybe I will touch the last two, and CFO will sum up on the Basel and revenue functions. I will start with the last one. I think the last one about whether our regional expansions are we looking for next region to next market to operate. The answer is still yes. We had our roadmap to ensure that at least we are able to open at least 2 subsidiaries as a proposal on the current study. We are still looking about the entire East Africa market. We have made priority center in terms of which country we should go after. I think we had some delays for KRC. That has been the reason why we have moved to the next one, because we wanted KRC to be stable in the operations, so that we're able to think about moving to the next market. So the plan is still there. The aim is to see that the relative share likely, I think in the next market we are targeting, look like there are maybe 2 main choice of one. That is Zambia, it's our main market we looked at. And we are still also looking at Ghana as a market to look at it. And the other small market, the like of Comoros. But will that to be determined at the stage when we have established our DRC. I think your next question was about what kind of study we have for the post organizations. I think I just shared with the members in the call that this Friday we are launching our infrastructure for 5 years, looking about to raise a range from 150 to 500 possibly billion shillings. That will be supporting the operations and focusing on the infrastructure. And given the nature of the operation of the infrastructure, they are not on balance sheet kind of demand. They are more off balance sheet, but they have hand deposit paid from their payment of those advances. And the second issue is what I've just shared with you in terms of what we are currently doing on the financial inclusion agenda under the umbrella of CRDB foundations, focusing pure on the special women and youth. I think you can also agree with me that the small businesses where you get more or less affordable deposits, these are the special groups which need to be tapped. With the current tools in place, we should be able to get more. The third particular strategy which we are doing is to use our current infrastructure in terms of alternative channel. As we speak now, we have enabled our Alliance Bank with the new robot systems, which enable them to acquire customers and bring deposits in. They actually create their own customers on their spaces. With the current system, they're able to separate between payment systems, acquisition systems, and other services. And we have seen the benefit of it. So we intend to use those particular channels to acquire them. The last part, because I think there are many, is about the current ecosystem we have created. As we speak, using our digital payments, we are now integrating majority of the institutions in terms of payment, enabling to do payment seamlessly within the bank. And that will obviously enable those ones who are being paid to ensure that they are paid within the bank. We have deployed a platform, our value chain mechanism framework. And that is enabling where we deal with the customers in a risk perspective, from the corporate level to the distributors and suppliers. And your president, I think in the last 2 days, we have also launched a partnership with big oil suppliers, the like of Puma, the like of Total, where we have now integrated our system with their distributors and the petrol stations, instead of becoming a collecting agent in a seamless way. We believe with those participation and many others, we should be able to maximize more deposits as we speak. And I think you can also see from the industry perspective, if you see our current deposit base, either be the other competitors, is a bigger gap. But basically, is how we have deployed our strategy to make that particular deposit for relationships. And let me allow CFO to cover the Basel and departmental functions.
Thank you, MD, and thank you, Chris, again for this question. On the Basel, yes, the Basel 2, Basel 3 is already on parallel line, and is the coming effective April 2025. So all the banks are supposed to go to Basel 2, Basel 3 by April 2025, but already they are on parallel line. So that's the update on the Basel 2, Basel 3. In terms of the split of the revenue, our to see more of the revenue towards that contribution, particularly when you see where we are going. Above actually is in the range of 60-65, and that's where we are focusing when we talk of the digital channel, when we talk of the usage and the financial inclusion. That's where we see most of our volume. So that answers in terms of the split. I think MD had responded to the rest of the question. Thank you.
Thank you very much. I would like to note that and emphasize that the Samia Infrastructure Bond is being launched by CRDB. It's launching on Friday this week, and it's open to all investors. It's a bond designed to finance road construction, and particularly rural and small urban roads. This is a great initiative. We at iTrust are very honored to be co-transaction advisors, co-sponsoring brokers, and given this task by CRDB, and we are really very grateful for that, to be part of the journey of funding this important economic segment for the country. So coming back to the last question, I think I will ask a question on behalf of Johan. He's asking a question on FX liquidity and the availability of FX and the currency strengthening recently, and how that impacts the bank.
The question is about FX liquidity. And I think what we see currently in the market is quite significant deposit when it comes to foreign currency. We no longer have a challenge with dollar, but there is also a challenge with T-shirts. And we have seen being one of the, I would say, the challenge for many banks in the market, because the government has not spent as expected. We have had discussions at the central bank level where we have identified that there are still a couple of suppliers whom will be possible to be paid toward the end. But the government, that's what we expect to see influence on the shilling side. But given on the current dollar side, I think we are very rich in dollar. And there is no challenge as we see, it's all on T-shirts. But with the extent we had the Ministry of Finance, Central Bank, there is still confidence it's more of a short-term challenge, and they should start raising the payments, which obviously address the gap we see today. Thank you.
Thank you very much, Abdulmajid and the whole team at CRDB. Thank you very much, all investors who have attended. I think with that, we can bring this results call to an end, and I hope everybody had their questions answered. Thank you very much.
Thank you very much, Prof, and thank you for organizing this call. We really appreciate your investment in terms of credits, but also the way it has been being helpful to inform our stakeholders. What I would say that you have just done that we are launching Samia Bond Infrastructure this Friday. So I would like to take this opportunity to invite all the participants of this call to come through, but also be ready to invest. I think it's a great investment, and the structure looks good. It's a corporate, it's about 12%. It's a 5 years bond, payable quarterly, which I think is a great structure to invest. So I welcome our participants, stakeholders to continue and to invest in this particular issue. Otherwise, I'm looking forward to see some of you, if not all of you, on Friday. And you're most welcome. Thank you very much.
Thank you very much. I think your call is being answered. I think investors have heard it, and I think this is going to be a great success. Very much appreciated everyone for attending the call. Thank you very much and have a great evening.